Most people think that mortgage rates are the whole story when it comes to buying a home, but let me tell you, this is just a small part of the equation. Hi, my name is David Moyer. I'm with Keller Williams Advisors here in the greater Dayton area, and I am here to tell you there is so much more than just your mortgage rates when it comes to buying a property. If this is your first time joining my channel, make sure you hit the like button, subscribe, leave me a comment, feed the algorithm. I have different topics every single week, and one is bound to help you along the way and probably save you some money. In this video today specifically, however, we're going to jump into how buying shifts and how that buying power shifts when rates move just ever so slightly. We're also going to talk about real math. People talk about rate buy downs, especially in this economy. What does that math really mean for me? How does it work? What are the local lender advantages? What do pre-approvals mean versus pre-qualifications? That's a big one. And what are the loan term differences? Right now in the news, we see a lot of people floating the idea of a 50-year mortgage. We're going to do a little bit of a dive into that so we can explain to you whether or not that's something that is going to be good for our home buyers or something that's good for you. And also, I want to go over why this matters most, especially here in the greater Dayton area. So stay tuned. Thanks for joining. Oh, and make sure you stick around to the end because I'm going to share my top strategy that my buyers here are using to secure their properties and save a heck of a lot of money. So first, let's really get into buying power and what that really means. So when I talk about buying power, I mean if you are spending the same amount of money today or tomorrow and your interest rate is different, what does your buying power really do? How does that affect your monthly mortgage? Let's take, for example, a $300,000 purchase price on a home today. At 6.5%, the monthly principal and interest on that loan is going to be roughly $1,869. So that's almost $1,900 per month for that $300,000 loan. Not too shabby. But at 5.9%, that actually changes everything to $1,775. So you're saving on average about $120 a month for that 0.6% change in the interest rate. Over the course of 5 years, that's $7,000. So that could be money that you've also been saving for a furnace or an air conditioning or that big vacation you want to take your family on. So that half a point difference can make a difference in terms of the monthly payment. Over time, it can compound and you start to see the real savings. But the thing is, if you're looking at a property that you absolutely fall in love with, it's perfect for your family, and you're saying, well, I want those rates to drop, that $120 extra a month that you're paying now versus what you could be paying if the rates were to drop is really not going to be realized if that's what you're waiting on, because by the time those rates change, more than likely that home value has gone up. Now let's talk about something that's gained a lot of popularity recently, at least over the past couple of years, and that is the rate buy down. And a lot of people ask me all the time, what is a rate buy down? What does that really mean? Is it something that I should consider? And there are goods and bad issues with rate buy downs. So there are pros and cons. If you were looking to stay in a property for a long period of time and you're getting in at a rate that maybe you want to buy down a little bit, you can pay up front to actually reduce that interest rate ever so slightly to save you on the monthly, and it's going to be worth it because you're going to make that up on the end because you're staying for a long period of time. However, if you're looking to purchase a home and maybe you're relocating here at one of our Air Force bases and one of our military personnel moving into the area, and you're stationed here for maybe only 3 years, 4 years, maybe even 5 years, buying down that rate on the front end could cost you a heck of a lot of money that you're not really going to realize over the short period of time that you're staying here in Dayton. Let's talk about what a rate buy down technically is. A rate buy down is when you pay up front. They're called discount points. And these discount points are what the lender charges you to reduce that rate, sometimes permanently, sometimes just for the first couple of years. And the definition of a discount point, one discount point typically is 1% of the loan amount. So that's important to think about too. If you're purchasing a $300,000 home and you want to buy the rate down, discount point is going to cost you $3,000. And typically it can lower your interest rate by 0.25% per point. It varies lender and different conditions, but if you're looking at adding that up and you're saying, I want to reduce my interest rate by, let's say, 0.5%, and you're buying a $300,000 home, this may cost you $6,000, $7,000, $8,000, $9,000 to accomplish that, and it may not actually be saving you that much money. Remember at the beginning of the video, we talked about a difference in 0.5% interest, and you are looking at, over the course of 5 years, saving $7,000. Once again, if you're paying that up front to get that interest rate difference, you better be staying in the home longer than 5 years. Also, there are permanent buy downs. You can pay the points up front, your rate is permanently lowered, but it's great if you plan on staying in your home between 5-10 years, if not more. Beyond that, there's something called a 2-to-1 buy down. 2-to-1 buy downs is on year 1, the rate is 2% lower. On year 2, the rate is 1% lower. And year 3 through 30, or however long you're in the home, the rate returns to the normal rate it was when you first started. A lot of times you can get a seller to fund these. They're a little bit more economical because they're not permanent, and we can dive into those. If you have any questions, just leave me a comment. Also, there's the 1-0 buy down. This is the first year is 1% down, and then after that, it goes right back to the original rate. Now, in Dayton, especially at price points above $350,000, sometimes sellers are more frequently offering these types of buy downs. As opposed to closing costs or other concessions, they're actually offering to buy the rate down for the consumer. So the consumer can get into the home for the same price, but maybe have a lower monthly payment. See what I'm talking about? There's a lot more than just interest rates. Now let's talk about our local lenders here when it comes to shopping around for a mortgage and seeing what product's best for you. And when I say local lenders, I mean local lenders. You can go online, apply for a mortgage, and you are going to be inundated with emails from lenders across the country. And this can be rather confusing. It can also be a lot stressful and cause a lot of anxiety when you're going into one of the largest purchases you've ever gone into before. The local lender is going to have a little bit more flexibility, and they're going to have a greater finger on the market and the local pulse of what's happening. When a lender is local, their appraisers are also local. These local appraisers are going to understand neighborhoods like Oakwood, Bellbrook, Kettering, Beaver Creek. They know the difference. They're not sending in an appraiser from Columbus or Cincinnati to come to the greater Dayton area to do the appraisal. They're working with local appraisers. Local lenders can close on average about 7 to 10 days faster. And the reason they do that is because everything is hyper local. They're easier to access. It's a lot more one-on-one time, and those underwriters have a lot more flexibility because they are local and they're on the same time frame. So closings can be a lot faster as well. Also, when it comes to rate lock extensions, this is something when you go under contract, you're going to lock that interest rate that you have. That way, if it goes up, you're still guaranteed to have that rate when you close in 30 or 45 days. But what happens if there's an extension that's needed? What happens if the inspection causes things to be delayed a little bit because of repairs? What happens if there is an issue with the financing, but it's going to be resolved, you just need a few more weeks? You have to get a rate lock extension, and those can be costly depending on the lender that you're working with. But if you're working with a local lender, they're going to be able to negotiate that with you and make sure that it works to your advantage, and they're going to be able to help you out a lot more than those national banks and national institutions. And they also offer lower rates at the end of the day and lower fees, especially if you're in the Dayton and Cincinnati market. Questions you should ask your lender. What's your rate lock options? How long is this rate lock good for? What are my options if we don't close on time? What is the full fee breakdown beyond just the rate? Your lender should be telling you this up front. The lenders that I work with always give a full fee breakdown to all of my clients. Transparency is key. If they're not being transparent with you, then they're not the lender for you to work with, ever, in my book. And also, do you use local appraisers? My lenders do. I can tell you up front, yes, their appraisers are local. Do you offer temporary buy downs? And what are your typical closing timelines for Montgomery County, Greene County, Miami County? And also, what are the closing costs? When you're working with your lender, you want to have a very defined set of closing costs for 2 reasons. One, if you're purchasing the home and you plan on paying those closing costs on your own, you want to be able to budget for it. You're not scrounging to up that money at the end of the deal. Secondly, if you plan on asking a seller to cover those closing costs for you, you're going to want to know what those closing costs are up front, so that if we go into negotiating process, even over the weekend, you are set up with a plan and you know exactly what you're going to be asking those sellers for. Now, this next segment is going to be really important because I come across this all the time, whether I'm working with a buyer that's come to me or if I'm working with a seller and we're receiving an offer from a buyer, and that is the pre-qualification letter or the pre-approval letter. Did you know there's a difference? They're different names, of course, but I think a lot of people actually assume they're the exact same thing, and that's not true. A pre-qualification letter is just what it means. You have been pre-qualified. You're qualified, but we really haven't dug that deep into your background or what your history is. So it's just a soft review. There's no documents, just estimates. and they're not really all that reliable. So many times I'll see clients come to purchase one of my sellers' listings and they have a pre-qualification letter with them, and when it comes time to actually get that pre-approval, they find out they're not approved. So if you come to one of my listings, you have a pre-qualification letter, you better believe my seller is going to be asking you for a pre-approval letter before they move forward with any sort of offer whatsoever. Likewise, a pre-approval letter is just what it sounds like. The income, the assets, the credits, it's all been verified, as well as the debts. So it has a strong presence when it comes time to writing the offer. Those are things to keep in mind. Also, there's something called a full underwritten pre-approval. These are one of my favorites because if you're looking to negotiate in a tough market, these can go a long way. So the underwriting process that normally takes place after you go under contract, it's already begun. And in many times, it's already done. So they've gone through the entire process of re-verifying everything, making that pre-approval even stronger. And in my book, it's the gold standard when it comes to approvals and getting you into the property and helping you beat out some of your competition. Why it matters most here in Dayton too is there are a lot of multiple offer situations that still happen in certain areas, and the sellers prefer to work with a buyer who's done their homework, has their ducks in a row, and is ready to pull that trigger. Now, a lot of people will always ask me, David, what is the difference between whether I'm going after price or if I'm really focusing on the interest rates? Or why not both? And if you can get both, that's fantastic. But that doesn't always fall in terms of how our lives fall into place when it comes time to move and when we find that perfect property. So the key things I like to tell my clients is if you're looking at, let's say, homes that have been on the market for, in Dayton, let's say longer than 45, 60, 75 days, or if you're looking at estate sales, or maybe somebody that's relocating, or homes that need some minor cosmetic updates, things like that, then that's when you're going to really focus on the price, because you want that price to work in such a way that you have room to move, you have room to make upgrades, and you have room to do that sort of stuff. So don't focus too much on the interest rates, mainly focus on the price, because you can change that, you can upgrade that property, put some sweat equity into it. Now, on the flip side, when I do say that the interest rates can make quite a bit of an impact, that's when we're looking at things like new construction. Why new construction? New construction has a higher price per square foot compared to the average resale property. So interest rates are going to be a lot more important when it comes time to looking into purchasing new construction. And likewise, if you're a little bit more on the luxury side and maybe your price point is $500,000, $750,000 and up, those interest rates can make quite a bit of a difference. So the difference between a 6.5 and a 5.9 is going to be a lot more than just $120 a month. So that's where the interest rates come into play and can be a little bit more important. One of the things I always think about is sometimes the right home isn't always at the top of your budget. Everyone seems to think, I'm approved for $350,000, the perfect home for me is going to be $350,000. That's not true. The right home is not always at the top of your budget. It's the home that creates breathing room in your life. Repeat that. Write it up on your wall. Now, depending on when you're watching this video, this is a really timely topic right now, and that is the term of the loan in terms of the life of the loan or the life of the mortgage. Right now, there are several different types of mortgages in the market. The most common ones that we have right now are 15-year and 30-year fixed mortgages. And they are what they sound like. A 15-year is the life of the loan is 15 years, just like if you buy a car and you're doing a 5-year loan, this is a 15-year loan on a home. The most common one that everyone is most familiar with is the 30-year mortgage. That is the 360-month payment plan to repay the property that you have purchased. The difference between the two is your 15-year mortgage, rightfully so, is going to have a much higher monthly payment, but it's going to be bought down even faster. And the 30-year mortgage is going to be the standard time that we always think about when we're purchasing a home, and it's going to have your more robust but comfortable monthly mortgage payments. One of the things I tell my buyers up front, if we're focusing on a 15 or a 30 and you're trying to decide which one you should go with, I always recommend the 30-year mortgage. And the reason I recommend the 30-year mortgage, if you're someone like me whose income can fluctuate from one month to the next because of the type of work that you do, or you're really good at saving, then when you get into a 30-year mortgage, every month, if you make 10 to 15% more on top of that principal and interest, and add that onto your payment, you're actually going to reduce the life of your loan by anywhere from 7 to 9 years. So you can actually turn that 30-year mortgage and get it paid off in about 21 to 22 years. Also, if you're saying, David, I don't want to add that extra every single month, what's another way I can do it? You can also go in there and instead of making a payment once a month, you can make them bi-weekly. That does the same thing, has a very similar effect. Or you can simply say my monthly mortgage is $1,500 a month, and once a year when I get that bonus check or when I get this, I'm going to pay $1,500 extra in that 1 year. Instead of 12 monthly payments, you're essentially making 13. But when it comes to me personally, I like to add on the amount just a little bit per month that adds up to making one extra payment per year, and you watch that principal shrink dramatically. But what we're talking about here also is what's topical in the news, and that's the idea of a 50-year mortgage. I'm not giving you my opinion on what you should do if a 50-year mortgage ever becomes a product that consumers are able to use and want to use. One of the benefits of that would be it would greatly reduce your monthly payment. If you're looking at everything strictly from a monthly payment standpoint, it would reduce that quite a bit. However, if you're buying a 30-year mortgage, it's a $200,000 property. If you make the average payment every single month for 30 years, by the time you pay that off, you've actually paid close to around $400, maybe a little bit less, a little bit more, $1,000 to purchase that $200,000 home because you have principal and you have interest. Imagine doing that for a 50-year mortgage. You're buying a $200,000 property. If you pay it off in 50 years, you're going to pay upwards of $600,000 for that same property. If that doesn't scare you, I'm not sure what would. 50-year mortgage may help you in the short term, but if you're looking at this as a long-term gain, it's going to take you forever to pay that mortgage off, and it's also going to take you a lot of time to recoup the money that you could have been saving elsewhere. Back to that, in terms of 30-year mortgage, if you do go with the 50-year, if those ever become available, remember what I said about making extra payments. That can really cut that down there as well. This last segment is sometimes I feel like I'm a broken record, and that is, should I wait for the rates to drop? Should I wait for this to happen? Should I wait for these home prices to change? The bottom line is no. That's the best way I can put it. No. Because if you're waiting for that interest rate to drop, the interest rate today where you are is 6.5%. And you're thinking, I don't want to buy a house until that interest rate gets under 6%. Well, first of all, there's no guarantee that it ever will, at least not in our lifetime. But if it does, that may take a year, 2 years, 3 years. And what continues to happen over the course of that time is the appreciation rate continues to climb. That's not going to stop. And by the time you see that realization of the interest rate that you're hoping for maybe come into play, the home that you're looking to purchase, let's say for $300,000, is now going to cost you around $320,000. You're paying $20,000 more for the exact same home you could have already been in, and more than likely your payment is exactly the same as what it would have been had you purchased the home a few years back. Waiting is never going to be the answer. You're never going to beat the market when it comes to this. There's always going to be a buyer's market, always going to be a seller's market, and there's always going to be a good time to move. My idea is if you find into a property that you want to get into, if making that purchase and achieving the American dream and getting all this tax write-offs on a new property is something you want to do it now. Waiting until later could actually cost you a lot of money, regardless of what that interest rate does. We're talking about interest rates and home values and whether you should wait. A lot of people keep thinking, especially those that were around when the market crashed back in 2008 and 2009. I was there. I was a realtor. I started my career in 2005, so I was really in the thick of it when all of a sudden everything went haywire. And everyone keeps thinking, it's going to happen again. It's going to happen again. There's got to be a bubble. And if you're working with me here in the greater Dayton area or anywhere in the Midwest, we're a little bit more insulated. And there is no signs of any sort of economic crash, especially when it comes to housing, anywhere out there in the spectrum. And even if it did, over the course of you staying in that property for several years, the realization and the gains are going to come right back. So if we look at what's happened on a chart, in 2008, when those home prices plummeted, and then we saw what happened in 2020 when COVID hit and all of a sudden the appreciation rate skyrocketed, the trend line, it stays the same. Even though the housing prices dropped, they went right back up to where they were. So over the course of the past 20 years, even though fluctuations have happened, prices have gone down, prices have skyrocketed. At the end of the day, they remain constant on those trend lines. They always have, and they always will. So thanks for joining me. I would love to hear some of your comments, some of your ideas. Once again, my name is David Moyer. I'm with Keller Williams Advisors here in Dayton, Ohio. If there's anything I can help you out with, or if you have an idea for a video, I would love to hear from you. Any sort of comment that you make or subscribe helps feed the algorithm so that we can continue to educate other buyers and sellers out there, especially in the greater Dayton area. And if you're waiting on the rates to drop, I want to know what rates you're waiting on. Also, if you're thinking about what loan product do I want, especially after watching this video, 15-year, 30-year, 50-year, let's talk about it. I want to hear about it. Let me know. And once again, thanks for joining me. I love selling real estate in Dayton, Ohio.